Hello traders, Gary Wagner here. It is 12 o'clock in Honolulu, 6 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 30th day of August, 2024, and this is the evening report for gold and silver, our weekend review. Today's PCE report came in as initially forecast. However, the net result was a stronger dollar and rising yields that led to selling pressure and profit taking into the gold market. Gold declined by $18.60, fixed at $2,536. Silver had a much stronger decline than gold, giving up 1.98%, a total of 59 cents, taking silver futures to $29.24.5. Rising yields, along with dollar strength today, resulted in the sell-off experienced in both gold and silver. The dollar gained 0.34%, taking the index to 101.738. The dollar has strengthened for the last 3 consecutive trading days. Although the PCE report came in as anticipated, and many analysts, including myself, believed that that would provide bullish tailwinds for gold, that turned out not to be the case. This larger blue arrow points to 2:30 in the morning, which is 8:30 a.m. in New York, the time that the PCE report was released. Gold opened during this candle at $2,556, and then over the next couple of hours would trade to today's low at $25.26. On the way, when gold hit $25.36, it did stop us out. We went long at $2,539, out at $2,536 for a loss of $300 per COMEX contract. We will enter the 3-day weekend flat with no active trades. Although today's price decline suggests that profit taking from the recent move in gold might not have concluded, if in fact we do get continued selling on Tuesday, when gold traders re-enter the market after the 3-day Labor Day weekend, I believe that if that is the case, it would be confined to just about $10 because I see very strong and major technical support at $2,520. That being said, I believe that the profit taking we saw today that occurred as the dollar and yields rose will be confined to a one-and-done scenario as we saw earlier this week, and we will see gold rise in prices next week.
Silver lost approximately 3.5% this week, and on our weekly chart we can see that we did form a engulfing bearish on our weekly candlesticks. We could still head a little bit lower next week. If we put up our Elliott wave count, you can see that I believe we did conclude our 5th intermediate wave. That means our primary wave 1 is now complete, and we are in a wave 2. So how low can this current wave take us? Usually a wave 2 will not go past a 61% retracement of wave 1. The wave 2 usually extends somewhere around 61% into the first wave, which would take us right here at around $28.36. It could stretch as far as the 78% retracement and usually will decline further than its current print right at around the 38% retracement. That's why I do think we are still heading a little lower next week, and we should see a bounce anywhere from 28.80, the 50% retracement, to as low as the 78 before entering our 3rd and strongest wave, which should challenge these highs above $32. And if we overlay our Ichimoku cloud, we could see that the cloud formation did act as resistance this time. And with us being below the clouds and the cloud printing red, that still signals lower pricing is most likely ahead. To wrap up, we are in our second primary wave, and this is an approximation of what our impulse cycle could look like. Again, I do think silver will bounce back to the upside and will probably happen when the dollar continues to weaken, which is the opposite of what we saw this week.
This has been Gary Wagner
And Joseph Wagner.
wishing you, as always, good trading. We will talk to you on Tuesday. Have a great weekend. Bye-bye.